All right, why don't we get started? So thank you very much for joining. I'm Mark LaMonica. Look after the individual investor team from Morningstar in Australia. And today we're going to talk about income investing and particularly talk about, of course, how to find sustainable income from shares. So before we get started, of course, we have to go through our housekeeping items. So anything you hear today is general advice. I don't know anything about you. I can't offer personal advice, but I would like you to ask questions. If you're over in New Zealand, you can go onto our website, morningstar.com.au, to get a copy of our FAP. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. All right, so getting started, one quick note, our conference is coming up on October 13th in Sydney at the ICC in Darling Harbour. If anyone's interested in going or attending remotely, so the whole thing will be streamed online and all the sessions will be recorded and available for 30 days. We've got a great lineup. If anyone's interested in a discounted ticket, send me an email at mark.lamonica1@morningstar.com. I think it's going to be a good day. All right, so income investing. So we've got this little John Rockefeller quote, which I like. Of course, talking about dividends. So why are people interested in income? Well, you're probably interested in income because you're on here and watching this. But anyway, why are people interested in it? Of course, the idea of passive income is very attractive because basically what passive income is you don't have to do anything, right? So active income is what I'm doing right now, coming to work. Passive income, of course, income comes in from your portfolio, can hopefully support your life. And a lot of people see this as a pathway to independence, and in many ways it is, right? That if you can replace all or some of your salary with passive income, it gives you a lot of freedom. So a couple other things that are really important around income. So income and dividend income, if we go back and look historically at returns, is a very large component of total returns. So that is something that's really important to consider, and we'll talk a little more about that. The other thing is what many people, of course, are interested in doing is potentially lowering the volatility of their portfolio, especially as you approach retirement and are in retirement. So basically lowering the volatility means the value of your portfolio will bounce around less. Dividend paying shares have traditionally been less volatile than non-dividend paying shares. And there's a couple of reasons for this. Number one, just from an investor perspective, it is certainly a reason to hold on to a share, because even if the company is going through maybe a disappointing spell, or the market in general is going through a disappointing spell, the idea that you are still getting dividend income, of course, is attractive because there's a reason to hold on to that share. The other thing, of course, has to do with the company itself. So there are naturally companies, and we talk about this a lot, there are naturally companies where there are smaller ranges of outcomes versus larger ranges of outcomes. So basically meaning there, if we think about business outcomes for a company, large developed companies that are multinational, have lots of different products or in lots of different markets, are financially secure and can access capital, strong balance sheet, those companies traditionally are not going to bounce around as much in terms of the outcome that they have, right? So if we think about these giant companies, they're not going to double revenue next year, and they're not going to lose half of revenue next year. Where if a company is new, small, maybe has only one market they operate in, only one product they sell, there could be a lot more volatility. Now, dividend paying shares look like just those two companies I quickly described. Of course, the company more likely to pay dividends is the first one, the larger company that is established, because what do you need to pay dividends? Well, you need to actually make some money. And that does sound quaint, but if we look at the last year and a half and what's happening, a lot of the companies that were doing very well late last year or until late last year were not making any money. And we've seen them rebound lately, but those are the ones that lost so much of their value. So something important around dividend paying companies, it means, you have to actually generate cash to pay out to shareholders. All right, so let's look at that first point that I made here, the contribution to market returns. So if we go back in Australia to 1900, we can see that dividends contributed 53% of total market returns. And we'll show a chart on this later, but remember, there's two different ways that you get returns. I guess there's lots of different drivers of it, but really the price can appreciate, right? So that can be price changes in a share price. And also, of course, dividends that are paid for you. So 53% in Australia, 40% in the US. And there have been times, and this is the US, where you can see the income contribution to total returns. There are certainly times where dividends fall into favor and out of favor that we can see if we sort of go back and look at some of these different decades, but still overall 40% of the US. And then something that I talk about all the time, and we'll talk about why Australia is more in one second. Something that I talk about all the time is, of course, Jeremy Siegel, his book, when he went back and looked at the best performing share in the US, it was Phillip Morris. So Phillip Morris, $1,000 investment you can read in 1925, we're worth $250 million in 2005. A lot of that was from dividends, right? So tobacco companies were certainly out of favor. Just, number one, because smokers were declining. There's a lot of government regulation. There were a lot of lawsuits. But at the end of the day, low share price, just churning out dividends. Because, one of the nice things about being in an industry that isn't growing, where the government is actually restricting you from spending money with things like marketing, one of the nice things is you generate all this cash, right? And think about how much it costs to make a cigarette versus what a cigarette pack actually sells for, even if we take out taxes, huge profit margin on those. So generating a ton of cash, not having to invest really in growing the business, cynical person would say that also helps when your product's addictive, but either way, dividends had a huge contribution and made Phillip Morris the best performing share in the US during that time period. And I think if we look right now, and I had a chat with Matt Hodge, who runs our equity research team about this, you think right now, what is something similar to cigarettes? It's probably coal at the end of the day, right? Nobody's building new coal mines. Coal is still being used a lot. And so from your own personal value perspectives, you'd have to figure out if that's something you were willing to invest in. But we've got constrained supply. We've got an industry that isn't growing, that these companies are not going to invest a lot of money. You're probably going to churn out a ton of dividends, especially with coal prices where they are now. Anyway, just my 2 cents. All right. So obviously, we've been hearing a lot about inflation recently. But, how are we doing if we divide up dividend growth? And one of the big advantages, of course, of dividends versus other income streams, whether that's going to a hybrid security, whether that's going to fixed interest, one of the big advantages, of course, dividends can be raised. And so stocks that increase their dividends during periods of high inflation, frankly, any period, have considerably outperformed the broader market, as we can see here, right? If we're dividing up the S&P 500 into dividend growers, and then looking at the ones that are growing their dividends the most, there we go. And that, of course, makes sense because these are the companies, most likely because they are increasing their dividend, these are the companies that are able to maintain pricing, right? So they're able to pass on those additional costs to consumers. They're able to maintain their market share, even with consumer behavior, which often shifts significantly during an inflationary time. And they are able to, of course, outperform the market. Oh, Lisa says coal and tobacco also both smoke when lit. That is true, Lisa. That is true. All right, lower volatility. So this is the other point we made. Okay, if we go back to 1990 and we look at something called the S&P 500 Dividend Aristocrats. So those are dividends that have increased their dividends, and dividends in the US are different. And I'll explain sort of how it works in 1 second. So they've increased their dividends each year for the past 25 years. They had higher returns than the market and less volatility. So this volatility that we are looking at right here is we're looking at the standard deviation. So basically what that represents is it looks at the dispersion of returns around the average. So the higher that dispersion is, the more higher and lower than that average return those shares are getting. So it's one of the volatility measures we look at. It's basically the sweet spot, which really these dividend increasing shares are better performance and lower volatility. That's not supposed to happen, right? So that's very rare. So for instance, shares have more volatility than bonds. They bounce around more in price. You are compensated for that more volatility by higher returns. So generally with investing, the more volatility you take on, the higher your return should be. But this is a case where you are actually getting, from 1990, you were getting higher returns and lower volatility. And that's sort of the sweet spot of investing. But let me quickly, and I've alluded to this a couple of times, talk about sort of dividends in Australia versus the US. So if we go back a couple slides, just so people are aware, if we go back to the slide, yeah, the dividends, meaningfully contributed more in Australia. So Australia is certainly a country that does love dividends. One of the big reasons, of course, and we'll get to this in a second, is franking credits. So obviously there are some pretty big tax advantages to dividend paying shares in Australia. So of course, what do? Companies pay more dividends. The other difference in Australia, because companies are trying to, of course, give shareholders what they want, the other thing in Australia is the dividends tend to be more volatile because companies will have higher payout rates. So we'll talk about this in a little bit, but a payout rate is how much of the earnings of a company do they pay out in dividends. So very simply, if I earned a dollar, I can speak. If I earned $1 as a company and I paid out 90 cents in dividends, my payout rate would be 90%. So what that means is, of course, I'm paying out 90% of what I earn in dividends. And we'll talk about some caveats later on. But if you have a higher payout rate, it means if there's volatility in the earnings, you might not be able to cover your dividends. So Australian companies, the dividends tend to fluctuate more because when the company's doing really well, they'll raise it really high. Then when the company does a little less well, they'll lower it. And people in Australia and Australian investors are comfortable with that because that's sort of what happens. That's not really what happens in the US. Cutting a dividend is seen as a huge issue for a company. So basically the payout rates are lower to give the company more cushion. So you tend not to get as many dividend cuts unless something is going really wrong in the company, not just sort of the natural ebb and flow during an economic cycle. So just wanted to sort of clarify if you're looking at those stats. All right, good question, Aiden. I will get back to that. And Lisa, I will get back to your question as well. Let me just get through a couple more. All right, so a couple considerations, and I think hopefully this will answer some of the questions that we have. A couple considerations when you are trying to invest for income. So the first thing is dividend reinvestment. So what dividend reinvestment is simply that instead of taking a dividend basically in cash, you get more shares. And the impact that this will have, and I'll tell you sort of both sides of the argument. The impact that this will have is, of course, you are compounding and growing your income even more. So, right. So at the end of the day, the perfect situation you want, of course, is you want to buy a company that is going to increase dividends over time. So, of course, if you think about that, all right, that's great. If I own 100 shares and 1 year they pay me $1, all right, I get $100. The next year they pay me $1.50. Now I have $150, so that's great. My income is growing, but you can actually compound that by reinvesting. So all of a sudden you're going to buy more shares, you have more shares, the income's higher. You can see sort of that snowball effect. So that's one thing that's really good about dividend reinvestment. The argument on the other side that a lot of people will make is, yeah, of course I'm going to reinvest my dividends, but I want to choose where they go. So I won't have dividend reinvestment on any of the shares in my portfolio. They will pay me a bunch of cash and I'll buy other shares. So not necessarily the ones I own, or maybe just one of the ones I own that I think is an attractive opportunity. But I'm not going to just automatically do that because then like all of my investments are growing a little bit, but I can make a better decision. So that's the other argument. And of course, we know the answer there, or we know the decider is, can you make a better decision or not? So it's really kind of up to you there. All right. So a big factor that's probably underappreciated is, the key if you're trying to build an income producing portfolio is what is your yield at cost, right? We always hear about dividend yields, and that's important. And dividend yield is simply the amount that's paid out as a dividend divided by the share price. So, simple example, $10 of the share price is $10 and it is paying out 50 cents a year in dividends, you're going to have a 5% yield, right? And so we track that over time, but really the yield that's most important to you is the yield at your purchase price, right? Because at the end of the day, if I sit there in that same example, that $10 share, and I have $10 to invest, all right, I know I'm putting that in, I'm getting 5% on my money. Obviously, dividend can get cut, it can grow, but I'm getting 5% on my money. If the share price goes up to, $20 in a couple of days, that's great for me. Dividend yield is now 2.5%. Like, it doesn't really matter, right? At the end of the day, yes, it matters if I sell it and I sort of know what income I need to replace, but think about that yield at cost. But one of the very important things that we'll talk about a little more is not stretching for yield. So basically, stretching for yield is on a simplistic basis. If I sit there and say, okay, you want to produce if you want to put together a portfolio that produces a lot of income. So one very simple thing that you can do that a lot of people do is say, okay, I'll just go look at all the highest paying dividend companies and I'll just put all my money in there, right? So what's the way I can generate the maximum amount of my portfolio? Well, I buy all the highest yielding shares. But that can be a problem. It can be a problem for a couple different reasons. So the first problem is that, of course, dividends, as opposed to interest that you would get, dividends are not guaranteed. They're not a contractual obligation of the company. Whereas if you buy a bond, that is a contractual obligation. Now, the company can go out of business and default, but still, while it's a going concern, they have to pay you that money. Dividends are up to the discretion of management and the board. So they can choose to cut dividends. They can choose never to raise them. And because of that, one of the problems, and because dividend yield is impacted by price, if a lot of investors think that a dividend cut may happen, if they know the company's doing very poorly, they, of course, will sell the shares. The share price will go down. The dividend yield will go up because the dividend yield is based on the past. But of course, what do we care about as investors? We always care about the future. So sometimes when you're chasing yield, you're in fact buying companies where you think you're going to get a lot of money, but all of a sudden that dividend gets cut because the yield is high because the share price fell. So something important to worry about. If you're building a portfolio, an income portfolio, and we talk a lot about diversification, right? Talk about spreading our bets. Look at your diversification by income source. Because once again, if we're trying to create this portfolio and we're trying to live off of this, right, we want less volatility in the income. So same thing that we would do with shares, not putting all our eggs in one basket. Make sure that you understand and make sure that the dividends overall from a portfolio perspective come from a lot of different companies. In case something goes wrong in that company, it's not going to sink your whole income strategy. All right, so this is the question, which we will get to, that Aiden asked. So he said, do you recommend dividends from dividend-focused ETFs, or is there more upside in stocks generally? All right, so I've actually been trying to write an article on this and kind of phrase this correctly in the article. I'll do my best just to speak to it now. But there are differences that you need to be aware of in terms of the vehicles that you go get a dividend from. And I think we actually cover this later. So roughly, we'll put them into three buckets. There are ETFs and funds, and I'm putting them in one bucket because they're basically the same thing at the end of the day in terms of how income is passed on. LICs, and then, so that's a licensed investment corporation. And then there's, of course, just buying the individual shares. So buying an individual share obviously makes a lot of sense, right? You go out there, you buy a share, you get whatever the dividend is. It just gets passed directly to you. The company will declare it. You'll know what it is. Then comes to you. Funds and ETFs are different. So funds and ETFs are pass-through entities, basically saying that the structure, the sort of legal structure around that fund and ETF requires them to pass you all dividends and all capital gains. And that's why they're called distributions. So it's not actually called, I know that this sounds technical and ridiculous, but ETFs and funds do not pay dividends, they pay distributions. And the reason it's called the distributions is because it's not all dividend income. So the problem that a lot of people get into with ETFs and funds is people will go buy an ETF because they'll sit there and say, oh, wow, the dividend, really the distribution yield is great on this thing. So I'll go buy this. But potentially a lot of what was passed on to you could have been capital gains. And this can happen in certain market conditions. And so the problem is that a lot of people expect these things to continue, but if a lot of it is capital gains, maybe they won't. So that's something to be really wary of. And the perfect and the classic example is there's an ETF called the Fang Etf. So the Fang Etf is, of course, ridiculous. If anyone's listened to me talk about this before, but it is basically 10 securities. So it's an ETF with only 10 holdings, 10 shareholdings in it. And it is like these high flying, NASDAQ stocks, right? Technology companies in the US. So it's got these 10 securities. Because it only has 10 securities, it rebalances its equal weight. So the equal amount of money is in each one of those. So 10% in each. And to keep it that way, because these shares are very volatile and there's only 10 of them, they rebalance quarterly. So last year, all of these shares were doing really, really well, of course, because these are all the shares that were going up a lot. But of course, they weren't all going up together. So there was this rebalancing event where, and in rebalance, when the share market's going up, what are you doing? You're selling your winners or the biggest winners with the biggest gains. And you were then putting that money into the either losers or ones that didn't gain as much, right? That's how we balance out that portfolio. So what happened is there was this huge distribution out of this ETF, and everybody all over the internet was going crazy about, wow, this is amazing. This is generating so much income, but it wasn't income, right? Because when you're selling those companies that do really, really well, of course, you're generating a lot of capital gains, and those capital gains are passed on to you as the ETF holder so that you can pay taxes on it. So everyone's really excited about this. But if you went and looked at the 10 companies, and it was easy to do because there was only 10 of them, 9 of them didn't pay a dividend, and one of them was like yielding 0.5% or something like that, paid like a very minuscule dividend. And people were all excited about this income. None of it was income. So then, of course, what happens in a down market? They're still going to rebalance. In this case, they might be selling things that didn't fall as much to buy things that fell more. You get no capital gains distribution, so nothing was paid out. And so it's just an example of how some of these ETFs can be dividend traps. So be very, very careful about ETFs with dividends. So basically what you need to do is you need to explore a couple different things, explore the underlying securities that are in there and see, okay, well, do the companies in here actually pay dividends? That's one thing. The other thing you need to do is look at their rebalancing, right? So I use an extreme example of that Fang ETF. Most ETFs and indexes do not rebalance that way, but just go look at what the rules are for rebalancing. So a lot won't do this at all, right? They'll only sell something if it goes in and out of an index. But just make sure you understand that, particularly with some of these dividend-paying ETFs. There's a lot of them in like strange ways, specifically ones marketed as dividend-paying ETFs. So just something to look for. All right, the last one is a LIC. So LIC, this licensed investment corporation, it is not a pass-through entity. So the manager of the LIC, and LICs are always actively managed. So the manager of the LIC, person who's making the decision, or the people that are making the decision on what to buy and sell in the LIC, also can choose when to distribute incoming capital gains to you. So they don't have to do it as it happens. And when I say as it happens as an ETF or fund, they do it generally quarterly. So anything that got paid out in that quarter, any capital gains generated just gets paid out. So whatever their dividend policy is or distribution policy. For a LIC, they don't have to do that. And a lot of people that are looking for income invest in LICs. Of course, the managers know that. So what they're trying to do is smooth out those income payments because they know that's what people want, right? Just like as I was saying before, if I want to live off of income, I would like it not to fluctuate as much. Like it'd be pretty annoying, right? If you go into your job and, you know, for one fortnight, they're like, this is your salary. And then you come in the next fortnight, it's half of that. And then it doubles. Like, it's not a great way to live, right? It makes it very hard to plan things. So that's the difference with LIC. So basically they can reserve this. And we saw it during 2020. There was a lot of volatility in the distributions that came out of ETFs, reflecting the fact that a lot of companies cut their dividends, right? To try to preserve cash during COVID when they were making less revenue. So you saw a lot of fluctuations in ETFs and frankly, the underlying shares as well in where you're getting income. A lot of the LICs were actually pretty smooth because the managers reserved these capital reserves and then paid them out during a very financially stressful time. So that's something to think about. The last thing to think about if you're looking at different vehicles is remember, the fee is going to come out of that distribution, basically. So at the end of the day, they're going to take a fee out, of course, the management fee of whatever you're paying for that fund or ETF. And just remember that that compounds over time. So what that basically means is you'll have less money because they're taking the fee out. And a lot of fees are pretty low, but because they're taking that out, you have less money. That's going to slow down that income growth. So something to think about. And yeah, that last line, I think I've kind of talked about, anticipate volatility in income. Yes, you know, income can bounce around. So if you were trying to build a portfolio, especially in Australia, because of what I talked about, if you were going to build a portfolio that you're trying to get to support yourself, remember, it's probably going to bounce around. So think about different ways that you can protect that, whether that's like almost like an offset emergency account where you can draw cash if those dividends fall. But just think about that if you're trying to live off of it. Yes, Graham saying listed investment company. Sorry, I was saying licensed. Listed investment company, which they are listed, so they trade on exchange. Sorry about that, Graham. All right, so Lisa says, should we expect lower dividends this year due to the bear market? You know, I wouldn't say, remember, and this is, and often they go in conjunction. Remember that like the economy and the share market are different things. So, you know, the share market can do very, very poorly if the economy is still doing okay, and vice versa. So a lot of that is just because of the share market generally anticipates things that are going to happen. And, you know, the classic example we talk about a lot on this is the GFC, right? The US share market bottomed like, you know, 7-8 months before like unemployment hit its peak. And, you know, there can be differences. So should we expect dividends to be cut? Potentially, right? It is sort of a challenging economic time as companies are dealing with inflation. There's a lot of concerns that even though the economies are doing very well, which is why we're seeing all this inflation, there are a lot of concerns that with central banks raising interest rates that they will push the economy into a bear market. Push the economy into a recession, right? So that's where I'd start to get concerned. So depending upon kind of central bank policy, if we get into that area, yes, we could see dividend cuts. But remember, like in a lot of them, we saw BHP this week, right? A lot of these companies are still living off of obviously the dividends come from the past, right? How you performed in the past. A lot of these companies are still doing very well because frankly, the economy in general is doing pretty well, which is why it's overheating and why we're having inflation. So potentially later on, Lisa, is what I would say. Okay, really good question. Which one is better? A non-dividend paying company like Berkshire Hathaway or a dividend paying company for both growth and income? Well, I'll have a couple of comments on this, but it is up to you and your goals, which one is better. Let's talk about the theory behind both of these, especially the ones you mentioned. So Berkshire Hathaway, Warren Buffett's company, famously has never paid a dividend. And Warren Buffett's argument is, hey, I'm really good at allocating capital. In other words, I'm really good at taking all this money generated by my company and figuring out what to do with it. So whether that's investing it in buying shares, whether that's going out and buying a company, he's saying, hey, I'm pretty good at this. So I'm not going to pay you a dividend because I can make a better decision with this in terms of growing the overall return than you can if I just give it to you. So that's Berkshire Hathaway's argument. The counter to that argument is, yes, you are Warren Buffett. there are very few Warren Buffetts, if any other Warren Buffetts. So does the average CEO of a company make better decisions with the cash that they generate? And there's a lot of arguments either way, but like people can do very stupid things. Management can do very stupid things with money. So whether that's going out there and buying a really overvalued company, because, once again, a lot of CEOs get into this kind of empire building, right? Bigger is better. Want to grow the company, want to go out there and acquire stuff so I can get in the front page of the AFR. All of this stuff that they want to do destroys shareholder value ultimately, especially if they pay too much. And so if you go back and look at all of the companies that have been acquired, like a lot of those are dumb decisions. The other thing, of course, you can do is you can reward all your employees and give people bonuses and raises. You can get a plane for the company, all this stuff that might make you very popular as a CEO, but doesn't really help me necessarily as a shareholder. So the other argument is that, okay, this is going to impose some discipline, paying out dividends and having to try to meet that dividend payment every year because you don't want to cut it. That imposes discipline on a company. And a good example of this is the miners. So the miners got really criticized back in like the early 2000s because there was sort of this bumper or in the 2000s, there was sort of, iron ore went through the roof and all these companies were making all this money and they were doing stupid things with it. Shareholders ultimately decided, going out there and developing a bunch of stuff that didn't have to be developed and things like that. And so now a lot of them are paying huge dividends instead, right? And we haven't seen production grow as much because they're not investing out there in new mines. And remember, with a lot of these commodities, you're in this sort of cycle where high prices lead to expanded production because you're developing more mines, and that of course crashes prices. So that's why it's very cyclical. But it's a good question. So it's sort of what you're interested in, right? And do you trust management to make good decisions? So Lisa says high quality companies that pay dividends combined with hybrid securities can be a reliable way to an income producing portfolio. I agree. All right. And then Graham, of course, with my listed. Okay, so let's talk about a couple of the considerations we have. So that's Tina Turner, by the way. So there is no alternative. Tina. So we've heard this a lot. Basically, we heard this a lot. And interest rates are still low, by the way. I know they just seem higher. But we heard this a lot when interest rates are really low. Like, all right, the only place I can get income is from the share market. So we still say like your bank account doesn't pay you anything. You can't go get a term deposit because you get nothing. Bonds were paying nothing. They're still not paying very much. So I need to go to the share market, and that's where I can get my income. So yeah, we'll start at the bottom, maybe fixed interest. As I said, predictable income, really low yields. And remember, fixed interest, not a great place to be in an inflationary environment, right? Because that payment, while predictable, will not change. At least in an inflationary environment, if, of course, prices are going up, companies will make more money, potentially. Obviously, there's a lot of different things, but at least they're able to potentially pass on those price increases to consumers by raising prices themselves. That's why we have inflation in the first place. So if they make more money, they can raise that dividend. So remember, that's a big difference. Hybrids that Lisa just mentioned. So generally what you get is you get higher income than fixed interest and lower volatility than shares in a hybrid. So hybrid is basically something that has debt and equity characteristics. It sits, so when we talk about subordination at the end of the day, just means like, okay, if the company goes out of business, who gets paid? What's the pecking order of who gets paid? Well, bonds get paid first. Fixed interest gets paid first. Hybrids are below that. Shareholders are at the end, right? You only get money if everyone else has got paid if you're a shareholder. But that's only if a company goes out of business. People love hybrids because they have franking credits. But just remember, there is higher credit risk on them. But a lot of people like hybrids, and I think for good reason. We already sort of talked about ETFs and funds, that split between capital gains. Let's just cover domestic shares versus global shares. So why do Australians like to invest in domestic shares? Of course, because you get franking credits. And we'll talk about the return you get, what franking credits contribute to returns. So generally in Australia, you get higher yields because once again, we talked about that companies, because investors love dividends so much, companies in Australia, because Australians People all around the world love dividends, but Australians especially love dividends. So of course, companies want to keep the shareholders happy. They would have higher payouts that generally leads to higher yields, especially in Australia. It's a lower valuation than the US, for example. So yeah, people like that. You get franking credits, as I said. What are some of the disadvantages? Well, it is more difficult to diversify your income in Australia. It's a smaller market. There's a lot of concentration in two different industries, right? Resources, which right now are doing well. We'll sort of see what happens going forward, but we've gotten huge dividend payouts from a lot of the big miners right now. So this is a very good time. But remember, there are also bad times, and there's a lot of cyclicality, and of course, financials, the banks. And if we go back to 2020, right? For a very long time, people were conditioned like, okay, the banks are always going to be these great sources of income. Well, of course, with what was happening in 2020, with a lot of suspensions of loan payments and everything else, the banks, of course, cut or suspended their dividends. So just remember, things are very concentrated in a couple industries. And most of the companies in Australia is more of a domestically focused market than other markets. What that means is that if we look at a percentage of revenue that companies generate, Australian companies who trade on the ASX generate, it's a higher percentage in Australia than, say, a US company, and certainly Europe. Europe, obviously, just because of the market, Europe and the UK, a lot of the revenue those companies generate, of course, come from outside of their home market. So that's not necessarily a good or bad thing. It just means that the companies in Australia are more reliant on the Australian economy than, say, the average large US company, and certainly the average large European or UK company. So something to think about. All right, so global shares. The advantage is, of course, the opposite of what I just said. You can diversify your income more. You can, of course, choose from a wide variety of sectors in different countries. Yeah, no franking credits and lower yields. And you have to worry about currency, right? So your income will fluctuate as currency fluctuates, right? So Australian investors have been protected a lot this year because the Aussie dollar has gotten weaker overall. So what does that mean? It means that the drops that we've had in US markets haven't impacted you as much, right? So counteracted those drops. So if we are in Australia investing overseas, we want the Aussie dollar to go down. Of course, because then those overseas dollars that your shares are valued in or priced in, and of course, income that comes in, if we use an Australia-US example, dividends in the US, the Australian dollar goes down, of course, you get more. So, but you do have to worry about currency, right? Especially if we're trying to build a portfolio, once again, that supports us to worry about those currency fluctuations, just another factor. And you can alleviate that by investing in ETFs that are hedged, where they remove that currency factor. But this year, it's worked out very well for Australians. And frankly, it has for a while, right? So what was it, 7-8 years ago, when the Aussie dollar and the US dollar, for example, were at parity, right? Like think about where we are now, right? We're in the high 60s. So that's been a big drop. That's all been very much to the advantage of Australian investors who have invested overseas. All right, let's talk about franking credits, because everybody loves franking credits. All right, so what we did is we went back to 2011, and this was till June 2021. So this chart is a little bit dated, and we looked at the return of Australian shares. So CAGR right here, compound annual growth rate. So what did Australian shares return every year in that 10-year time period? And where did that return come from? So price return, once again, that's just the share price moving, in this case, moving up, 5%. So 5% a year share prices went up. Then if we start adding in dividends, 9%. So you got 4% on top of that 5% from dividends. And this is us looking at the ASX 200. Then when we add in franking credits, you got another 2%. Now, you'll never see these franking credits in any sort of like index return, of course, because it's very personal, right? An index just tracks, the price return. And then if we look at the total return, what you get from dividends as well, you're never going to see those franking credits. But of course, you will see them if you're an actual investor. So this 11% isn't anywhere other than us going in and looking at the value of those franking credits. So yeah, you can see exactly what you got over that 10-year period from franking credits. You got 2% a year. Now, 2% a year is meaningful. I will say that. The other thing I'll say, and this isn't really an income investing thing, if you go back and look at like how the US market, you got way more than 2% if you invested all your money in the US. The US market did very, very well over this period. Now, obviously, there's nothing to do with what's going forward, but it's kind of both sides. Like, you know, a lot of people come and they say they will not invest outside of Australia because you don't get franking credits. And franking credits have a real value, 2% a year, and 2% a year is big, right? That is a lot. But just remember that you would have underperformed, even with those franking credits, US markets over the last 10 years. Now, nobody knows what's going to go forward. And actually, Morningstar, we project forward what we think returns will be. And we think Australian shares, because they're at a lower valuation level, because they didn't go up as much, we think Australian shares will actually have a higher return going forward than US shares are trading at a really high valuation level. Once again, that's just sort of what our investment management team thinks, but those valuation levels matter. But where did we get those? We got them because the US went up so much, right? So just something to think about in terms of franking credits. All right, so we can do a little case study here. And one of the things that you have to decide on when you are building an income portfolio is, are you going to try to find companies that you think will grow their dividend a lot? Or are you going to find higher yielding companies? Now, in theory, a company could be both, and that's a really nice place to get. But let's think about what actual dividends are. So companies, of course, have all sorts of different things they can do with the cash flow that's generated by that company. One of those things, of course, is to give them back to you as a dividend, or potentially a buyback. We're talking about dividends, give them back to you. Another thing is to invest in the company. Invest in the growth of the company, whether that's entering a new market, hiring new workers, spending more on marketing, lots of different choices, but you can invest more to try to grow the company. Now, typically, when companies are in high growth phases, they are either not paying dividends or they are paying very low dividends because they can get such good returns from investing that cash in the company, right? So if you're in this really fast growing industry, that's what you're going to do. Right? That's what most management would do. It's the smart thing to do, right? Like, I want to take advantage of the fact that there's really high growth. If you're in a more mature industry, you don't necessarily have all those things that you can do with the cash. So how am I supposed to grow? Like, if we go back to Phillip Morris, right? That example. So I'm a cigarette company. So, you know, number one, smoking is declining. So it's not like I need to build a new cigarette factory, right? Because actually volumes are going down. I can't market. I'm not allowed to advertise, right, by the government. So I'm not going to spend any money on marketing. Like, I don't know. There has been innovation now, of course, with tobacco. But generally there wasn't a lot of innovation. So what am I going to do with my money? I'll just give it back to shareholders, right? So there isn't a lot to invest in. So just remember that those are often trade-offs, right? That as companies mature, they'll pay off more of a dividend. And if you go look at some company that's paying, that has a 90% payout rate, like, you know, what does that mean? There's very little money left over to invest in the company. So you're always, most of the time, you're trying to figure out that balance between sort of high yield and growth. And this, of course, is very dependent upon you at the end of the day, right? And what your goals are. So if you're retired and you're sort of potentially approaching the end of your life, well, you might not have 15 years to invest in these growing dividends, right? You just want as much yield now so that you can go spend the money, right? If you're a lot younger and you're still interested in dividend investing, you're hoping that I can get to a spot when I retire and have my portfolio pay for me. Maybe growth is a lot more important, growth in dividends. So I might go out there and buy dividend payers that are yielding not a lot, right? Maybe a couple percent, but that I think will grow over time. So anyway, we did this little case study. It's a little bit dated, as you can see, given the date on there. We looked at Transurban. So Transurban is just an example of a company that sort of since their IPO, this is when they IPO'd, this was their first, dividend payment, just a company that grew their dividends, as you can see, pretty consistently across the years, and just looked at what would be the outcome if I took my dividend in cash versus I reinvested it. So what this is supposed to show is the power of growing dividends and the power of dividend reinvestment in a company I deliberately found, by the way, that had a really good track record, at least up until 2018, of increasing dividends. So what we can see here is if I take my dividends in cash, so very simply, we can see every year, so on an annualized basis, all right, what am I making? All right, so the first year I made $230 between the two different dividends, right? The interim and the final. Next year, $250, $285. You guys can read and you can see the growth. So really solid income growth those years. And then 2017, I made $545. That's pretty good, right? Like not a long time period. And I more than doubled my income. So what did I make? $3,225 over that period. And we had some really, really good growth. And we compare that 545 plus 230. But then here's the other. This is the dividend reinvestment. So in this case, I have 1,000 shares. I keep 1,000 shares the whole time. Here, I'm actually buying new shares, right? So you can see here, what did I buy in 2009? I bought 27 new shares. I bought 24 new, 27 new. With each one of these dividend payments, I'm reinvesting. So what you'll see here is all of a sudden it gets to 2018. I have 1,500 shares now. Right, so I have a lot more shares than this guy over here who had 1,000. And what you'll see is, okay, what is the total income now? Well, $807, right? So if I'm sitting there looking at retirement and I'm in 2009 and I want to retire in 2018 or 2019, I'm trying to grow that income. So in this case, I could turn off my dividend reinvestment plan and then start taking this in cash. I would get $807, which is meaningfully more than $545. Right. So this is just an example of that compounding effect that you can get by reinvesting dividends, especially if you can find a company where dividends are actually going up. So Lisa's saying, do international companies offer dividend reinvestment plans? I mean, the answer is yes, they do. I do not know, and this is like sort of a quirk of my own financial situation. I do not know if they do when you are buying them with an Aussie broker. So sorry, I don't have an answer to that. I've got a brokerage account in the US, so that's where I buy American shares, for example. I buy Australian shares, my Australian brokerage account. So I do not know, Lisa, so I'm sorry. But yes, if you're an American with an American brokerage account, yeah, they do. I just don't know. Yeah, I just don't know. So if somebody knows that, maybe they can answer that for Lisa. All right, so we want to talk quickly about sustainability. So of course, if I am an income investor, what is important to me is, when I'm going and, doing all this stuff we're talking about, oh, do I find something high yielding? Do I find something that potentially is going to grow? When I'm putting together this portfolio, what I'm trying to look at also is like, will these be cut? Because I want, of course, that kind of consistent income. So what are some different things you can look at? Well, one thing, of course, to look at is our economic moat rating. Now, why is that? Because, of course, if a company has a sustainable competitive advantage, it means in periods like we're going through right now, the company is going to hopefully do better. That's the whole point, right? That when competition in high inflation, when we have consumer behavior changing, everyone's trying to get as many customers. They're always trying to get as many customers as possible, but it's harder when consumer behavior is shifting, right? When prices go up and I have to start making decisions. All right, I'm either going to buy less of something, I'm not going to buy something, I'm going to, all sorts of these decisions that we're making. The companies are able to hold on to those customers that have that economic moat, of course, means they're going to be able to protect their profitability, which means potentially dividend won't get cut. Revenue growth is important. Of course, we do want companies that are growing. If a company is growing, it means, number one, they're less likely to cut the dividend, more likely to increase it. Customer concentration is something you can look at. So what that basically means is, are you a company that sells to millions of different consumers, where it doesn't really matter if Mark LaMonica decides to stop buying your product? Or are you a company that's selling to 4 different businesses, where if one of them drops you, you're in a lot of trouble? So both obviously can be good businesses, but all we're saying is that concentration, if you lose 25% of your revenue in one go, you're probably going to cut your dividend, right? Recurring revenue. So investors love companies with recurring revenue. It's that idea of software as a service, subscriptions, right? Where you just sort of tick on with these subscriptions, the software as a service idea that software is embedded within companies. It's very hard to get out. If you've got a lot of people in the company using it, it's very important to a company in terms of, how they make money. It's very hard to dislodge that software. And if you've got it on a subscription plan, instead of just selling the software in a one-time transaction, you've got it on a subscription plan, it's just recurring revenue. That is a good thing for companies. The more predictability around that revenue is the higher the dividends they can pay and the less likelihood it'll get cut. Margins. So of course, this goes a lot with economic moat. Are companies increasing margins? So the difference between the revenue they make and the earnings they make. So what goes in the top line, their sales, and then what they actually earn when it comes out the bottom line. Higher the margin, the better. If the margins are increasing, once again, that's a very good sign. The payout ratio that we talked about. So once again, the higher that payout ratio is, the more likely they're going to have to cut dividends if we see fluctuations in earnings. So if I have a 50% payout ratio, my earnings go down 20%, I could still pay out that dividend. Now, maybe I would still cut it because I had this huge revenue drop, but I could actually pay it out. If I'm paying out 95% payout rate and earnings drop 20%, in theory, I can't really keep paying that out unless I go borrow money or unless I spend down cash, which will not last forever. Financial strength is really important. So of course, in some cases, there are covenants, so basically rules within bonds that a company issues that they cannot pay a dividend if certain things are not met. We see this with banks, right? With banks, regulators can step in and say, no, you need to keep your capital, because banks, of course, keep capital to guard against people not paying back the loans, right? They're basically there to prevent the bank from going out of business if some people don't pay back their loans. So often regulators, and we saw this in the US around the GFC, we saw it in Australia, regulators will step in and say, you can't pay a dividend because you just don't have enough capital. You got to build up that capital. Stop giving it to your shareholders. You got to keep it to absorb these loan losses. So financial strength is really, really important as well. Okay, really good point by Bill. So Bill says that I often take the income distribution out as cash to rebalance a portfolio. Okay, so let's talk about what Bill is doing. So basically rebalancing is that when we have a desired asset allocation, so whether that's at a very high level that I want to put 50% of my money into Aussie shares and 50% of my money into US shares, that can be a very high level asset allocation, or on individual securities. I don't want any one position in my portfolio to be more than 5% of my portfolio, right? Just trying to keep that diversification. Like rebalancing, of course, is when you are bringing that back into balance, because of course, as relative, on a relative standpoint, even if they're all doing well, on a relative standpoint, if some things do better, they'll make a bigger percentage of your portfolio and they can get past whatever that threshold is. Now, the problem with rebalancing is, of course, depending upon what account this is, whether it's in a tax-free environment or not. But the problem with rebalancing, of course, as I talked about with those ETFs, is you generate capital gains because you have to sell the things that did well and put the money in the things that weren't doing as well. You can also rebalance with income, right? So income comes into your portfolio, you just put it into the stuff that hasn't been doing as well, and all of a sudden you can bring that back into balance. You can also rebalance with new contributions you make to your account. So that's what Bill's doing, which is a smart move, because that, of course, saves you from those capital gains. And we all want to minimize our taxes. All right. Doesn't look like we have any more questions, so we're almost done. So thank you guys for joining. Once again, if you'd like to come to our conference, you should come to our conference. So email me, mark.lamonica1@morningstar.com. I can pass along the agenda that we have. We haven't made it public yet, but we will shortly. I will pass along the agenda and I'll give you a discounted ticket. And yeah, you can come to Sydney, hang out in Darling Harbor with other tourists. Anyway, thank you guys very much. And if you have any questions, just send us through on email.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.